Vlad here. We had a very volatile year in 2017, which left a lot of people asking what's going to happen this year in 2018. A lot of people found themselves sitting on the sidelines, buyers especially, unable to make any decisions. Should we buy? Should we wait? Are the prices going down? And when that's going to happen. Sellers were paralyzed, clinging to notions of where the prices were a year ago or even 2 or 3 years ago, thinking that things will go back to normalcy in the immediate term and trying to wait with listings expiring at a record pace. So nobody really knew where that was going to take us. And a lot of people were considering that, okay, the real estate market is crashing, the bubble has burst. And all that was suggesting that the fundamentals within the marketplace have changed. We can look at this from a few different perspectives. The fundamentals may or may not have changed. And at this point, it seems that the market is stabilizing. There's a lot of fear mongering that's happening on the TV, in the news in general. And when we look at the latest report that was released, real estate report by Treb that was released in March of this year, looking at February prices, it seems that things are going downhill with the trading volume across the GTA being down at a rate of approximately 35%. That in and of itself is a suggestion that the market is not heading for recovery. At the same time, we ought to look at a broader picture. And the broader picture suggests something very, very different. Let's see at how aggressive the Bank of Canada is going to be in 2018 with regards to interest rates. And as we know, interest rates are the primary driving factor for prices and for purchasing power, for the control of credit that is infused into the economy, etc. That's the primary driving factor for controlling the inflation as well. So inflation rate, by the way, is at 2.2% at this point, which is about 0.2% above of the target rate that the Bank of Canada was hoping for, which might suggest that an imminent interest rate hike is going to happen in the next few months. At the same time, when the announcement of the new stress test had occurred, a lot of people equated this with the plan by the Central Bank of Canada to increase interest rates to approximately 4.5 to 5% in the next year to 2 years, which again is not something in the cards, and I'll give you a few reasons why. Let's look at what's happening south of the border. NAFTA agreement is in the process of being renegotiated. Nobody really knows the specifics, but the bottom line is that it will have an impact on the Canadian economy. What's happening with the latest announcements of the steel and aluminum tariffs? How is that going to impact the steel industry in Canada? How that's going to impact the Canadian economy? With the prices of oil domestically still being low, rather internationally being low, which impacts the domestic production of oil, right? So that impacts the Canadian economy. The burgeoning household debt, the overall level of debt that has been infused over the last decade into the Canadian economy, all those reasons are serious concern when the Bank of Canada is raising interest rates and decreasing credit availability within the economy. So if that is done imprudently, that can result in the economy spiraling into a recession, which is something that we don't want. If we look at the latest meeting that the Bank of Canada had, where there was an expectation of a potential for the interest rate hike 2 weeks ago, that didn't happen. In fact, given the fragility of the economy, it's unlikely that those interest rate increases are going to be consistent, that they're going to be large, and there's a question whether or not they're even going to happen. So if the interest rates are staying at the same level of 1.25%, that would be a huge stabilizing factor across all the markets within the economy, and real estate is going to be no exception. So let's look at why the real estate market had taken a dip in the last 3 to 6 months. One of the biggest reasons, if we look at all the series of announcements in 2017, was again the stress test. As the psychological effects, and a lot of people mistook psychology with the fundamentals, as the psychological impact of that announcement, which came into effect on January 1st of this year, are going to be waning as we're progressing through the year, buyers will regain confidence and will continue buying with an increased appetite real estate within the GTA. What that will result in is that there's going to be an increased volume of trading and prices will rebound and possibly will be on the increase. We're seeing that trend with the condominiums. They've been leading the pack across all property types with 20% appreciation year over year. We expect for that trend to continue. One exception for this year is possibly going to be when we're going to reach the peak of the market. Over the last couple of decades, the peak of the market has traditionally and seasonally been in the spring. That may shift from the spring into the fall market. In the summer, we're going to see again a traditional and seasonal dip in prices and volume, especially over the months of July and August. As always, we strive to help you achieve your dreams of financial independence through giving you advice on strategic home ownership and real estate investment. Please feel free to reach out to us at 416-835-0038 or find us on the web at www.mitramovesyou.com. Please remember to post your comments and let us know what you think about what's happening in the Canadian economy and specifically the real estate market in the GTA or Toronto in the comments section below.